Good morning and welcome to the Weekly Insights with John Plassard. Since 1997, share repurchases have surpassed cash dividends and become the dominant form of corporate payout in the US. That was before the coronavirus pandemic, when the Fed and the US administration were both raging against corporate buybacks, which, especially in the case of airline and various service stocks, were the primary reason why so many companies found themselves without a cash buffer as the COVID pandemic struck. If we could hope that companies have learned from the pandemic and that instead of distributing capital to shareholders, they would save it for darker days, we would have to revive ourselves. Because not only buybacks are back, they are back thanks to the Fed's approval of banks to generously return billions of dollars back to shareholders. According to Bank of America, buybacks over the past 3 weeks have picked up to their highest level since March 2021. With banks allowed to buy back stock again in Q1, financials buybacks increased back to March level. This phenomenon is expected to ramp up aggressively in the coming months as financial engineering returns to normal and as companies across all sectors resume issuing debt and using the proceeds to prop up their stock price. As a reminder, corporate America has been the single largest source of demand for equity since 2007. And indeed, on a net basis, corporate equity purchases vastly exceed other sources of demand, as ETFs were the second largest buyer, but still lagged behind corporates. If share buybacks are bad for R&D, it's a fact that they will be an important support for the US stock market in the coming quarters, notably for the consumer discretionary and on the other side for the industrial sectors. Have a very nice week, stay safe, read my morning, and please keep on winning.